Hi, I'm Paul Sanger for the Finance News Network, and today we're talking with Ausbil Chief Economist Jim Chronis. Jim is responsible for macroeconomic research and strategy. Jim also manages the Ausbil Balance Fund. Jim, welcome back to the network.
It's good to be here. Thank you.
Good to have you. Jim, I'd like to start by delving into Ausbil's projections for the economy and the markets for 24-25.
Good. I'll start on the global and I'll move into the Australian outlook. But for the global, last year we had a soft landing view. That now has moved into growth for the world with lower inflation accompanied with real interest rate cuts, which will be modest. So we're looking at growth at 3.3% for 24, and as we head into 25, getting closer to trend, driven by a resilient US economy and the other economies starting to grow. We're looking at an environment where inflation falls, but will settle above the 2% target that the central banks are achieving. So it's going to be sticky. We're looking at Europe, which has skirted recession in 23. It's in recovery phase, but won't be that strong. China is still embarking on expansionary fiscal policy to try and achieve those 5% targets. And as far as the geopolitics is concerned, that's the biggest risk to the outlook, and that's huge uncertainty. So to summarise, an improvement, a pickup in growth a broadening of the growth across the world, and it's a positive environment.
And Jim, there's lots of worries about the inflationary concerns, but geopolitics, there's quite a lot going on in the world at the moment in different sort of geographies that seems to be taking a bit of a back seat at the moment. Would that be your view?
It's simmering in the background. So you've got the Ukraine-Russia war, and the rhetoric from Putin has just escalated in terms of vitriolic threats. You have the Israeli-Hamas situation that is continuing. Hopefully there'll be a resolution there. And also that you have the uncertainty regarding China and possibility, its intentions regarding the Taiwanese Straits and Taiwan. But there are areas that are beyond my scope, but we are aware of them, and they do have consequences because you can see commodity prices react in the event of a skirmish. Oil prices could jump up, and they can have a knock-on effect regarding inflation and also an impact on growth. But that's not the environment that we're in, but we have to be conscious of it.
And what do you see as the key risks that you see to your current outlook for Australia? And additionally, what is your assessment of the inflation outlook for Australia, and where do you anticipate interest rates heading in 24-25?
Well, we've covered the outlook for the world. Yeah. Now let's move over to Australia. So we've had an optimistic view on Australia through 23. That continues through 24. To put things in context, Australia last year grew at a run rate of 2.1% year average. A phenomenal outcome given the headwinds that we were facing. For 24 that we're in, we're looking at 2% year average growth. For 25, we're looking at 2.5%, so to pick up. What we're looking at is an environment that's going to be fully employed with labour, the unemployment rate around that 4% mark, hanging on to the 50-year lows. We're looking at inflation falling, similar to the rest of the world, but lagging. We're also seeing that the drivers of growth will move away from the public sector and move more towards the private sector starting in the second half of the year. So we're through the low in terms of the impact of interest rate hikes. In terms of interest rates, we're looking at one rate cut for this year with another one to follow up next year. And again, it's all contingent on how services inflation, the profile of it plays out. And we're looking at an environment where Australia continues to benefit from China undergoing expansionary fiscal policy, which then leads to demand for commodities, which also then implies that the Australian dollar should appreciate from these levels.
Yeah. And so what potential risks do you foresee for the outlook that you just described?
For Australia?
Yeah.
That inflation turns out to be far too persistent. Yeah. As in sticky, that the Reserve Bank thinks twice about easing policy, maybe, and as a result of that we have rates staying where they are for an extended period of time, which then puts further downward pressure on the consumer. The business sector should be picking up, but I see a rotation away from the public sector to the business sector, and we get growth back to that 2 to 2.5 range, and that's quite a good outcome given the environment that we've come from.
Jim, what is your view on the inflation outlook for Australia, and where do you see interest rates going?
How about we reverse the order and start with the US, because they're important, and where the US heads, it gives you a good indication where Australia
Absolutely.
heads with a timing lag. So for the US, inflation peaked in 2022-23, and since it's come down. We know that the central bank is trying to achieve a target of 2%. At the moment, we're in the high threes as we speak, the headline and core. The components of inflation are very important when you're trying to analyse the direction for the US. Our view to be upfront is that we think inflation is going to be settling above the 2% target, but in that 2 to 3 range for the United States. And the reasons being is that up until now, goods have been in a deflationary environment as the economies have reopened. That deflationary force has now run its course and looks like it's stalling and will make probably a positive contribution to inflation. The other component is rental inflation. The forecasts there were for it to come down rather sharp, not by us, but by the market. My view has been that the delta of the change downwards would be slower because you have an imbalance in the housing sector in the United States where the demand for housing exceeds the available supply, and the cost of housing, especially through mortgages, have gone up relative to those who bought mortgages with a 2 or 3%, 30-year mortgage of 2 or 3% 2 years ago. So there's no incentive to change the stock. You need to add to the stock. So the rate of change in inflation on housing will be a lot slower. Add those two components together, the disinflationary force that we've had to now slows, and we still have services inflation staying relatively sticky. So the combined output is that you look at an inflation target, inflation profile for the US, which is going to be sticky in that 2, possibly 3 range going forward. That's for the United States. Now, what I've just described for you for the United States equally applies for Australia. We're looking at our forecasts a little bit higher than where the Reserve Bank's got it, slightly above 3%. Our problem here is that our services side of the equation is elevated. We need to see improvements there. So we need to see wages come down, and you need to have productivity come through. And unfortunately, our productivity to date has been poor compared to the United States, but I see a turning point there, and there's going to be a gradual approach to get inflation back down to those target levels.
So what you're kind of articulating in there is the data over the next few months is going to be absolutely key to whether we do see interest rates coming off in the second half in the US and in Australia.
The data is critical with regards to the timing of rate cuts, but you will get rate cuts because interest rates, when you adjust it for your projection regarding inflation over the next 2 years, in the US, in a real sense, are at 3. Historically, 3% has also corresponded with a pronounced slowdown in the US. This time you're not having it because the goods sector and the service sector are desynchronized. As those two sectors come more into balance, a real rate at 3 will have a greater impact on activity. So the central bank will do exactly what it did in 1994-95 under Greenspan, have modest rate cuts of roughly 2 to 3, sit back, assess, elongate the recovery in the United States to get it back in that 2 to 2.2% range, and that would be an absolutely fantastic outcome if they can achieve that, and have inflation somewhere in that 2 to 3% range, which is an ideal outcome. That's for the United States. For Australia, we're probably 6 months, maybe 9 months with a lag. In terms of interest rates, as I've mentioned before, we had 1 rate cut in the 4th quarter of this year, to be followed up with a second one in the 1st quarter of next year. That's 50 basis points, takes the cash rate from 4.35 down to around about 3.85. That should be sufficient for this environment, barring an adverse reaction in the consumer. We think the consumer is troughing and improving. And we're going to have tax cuts, don't forget. And then we also have the budget coming up in May. So there may be a few little gems in there for the household sector. So the profile is steady with modest rate cuts, and you have an elongation of the business cycle.
And Jim, lastly, can I ask what your views are on the US economy and how you think it will impact Australia?
I've been very positive on the US economy all through 23, even late 22 or 23. We were calling for a soft landing. My peers were all calling for a recession. It didn't eventuate. In fact, the US economy, to put it in context, in 2023 grew at a run rate of 2.5%. That's year average. That's up from just under 1.9% the year before. So you don't get a recession in that environment. For 24, that momentum is continuing. I've got roughly 2.1%. In 25, I'm looking at 2.2. They are quite strong activity figures, supported by labour market being at 3.8%, fully employed labour market, supported by a productivity dividend that you're seeing coming through in the United States from all the investment that's been driven by the fiscal stimulus measures that have been put in place under Biden and before that under Trump. And so the US is really quite a strong, resilient, solid economy, the likes of which sort of brings back memories of the 1950s and 1960s. It has that permanency about it, against a backdrop where inflation is within shooting range of those targets.
Jim Chronis, it's been an absolute pleasure. Thank you for your time today.
Thank you. Thank you.